Today, I'm going to talk about something that affects millions of people around the world: mortgage rates. But before I do that, let me ask you a question. Do you know what a mortgage rate is? If you answered yes, congratulations, you are smarter than 40% of Americans who don't know what it is. If you answered no, do not worry, you are not alone, and by the end of this video, you will learn everything you need to know about mortgage rates and how they can help you achieve your dream home. The mortgage rate is the interest rate that you pay on your loan when you buy a house. It may sound simple, but it can make a huge difference in how much you pay over the life of your loan. For example, if you borrow $200,000 for 30 years at a 3% interest rate, you will end up paying $103,554 in interest. But if you borrow the same amount at a 4% interest rate, you will pay $143,739 in interest. That's the difference of $40,185. That is enough money to buy a new car, go on a luxury vacation, or even start your own business. So how do you get the best mortgage rate possible? Well, that is what I am going to show you in this video. I will explain how mortgage rates are determined, what factors affect them, and how you can compare different offers and negotiate with lenders. By the end of this video, you will be able to save thousands of dollars on your mortgage and get one step closer to your dream home. But before we get into that, make sure you hit the like button and subscribe to our channel for more awesome content like this. And do not forget to turn on the notification bell so you never miss an update. Alright, let us get started. The first thing you need to know about mortgage rates is that a mortgage is a contract between you and a financial institution that grants the lender the right to seize your property in the event that you are unable to repay the loan amount plus interest. Interest rate. The interest rate represents the annual cost of borrowing money, and it is measured in percentage. This does not include any fees or additional costs that you might be required to pay for the loan. Annual percentage rate. The annual percentage rate APR includes the interest rate on the mortgage as well as other fees. The mortgage has a lot of expenses attached to it. These consist of the rate of interest, points, fees, interest rates, points, mortgage broker fees, and other costs associated with obtaining the loan are all included in the APR. Because of this, your APR typically exceeds your interest rate. Fixed mortgage interest. A fixed mortgage interest rate means that you will have an unchanged monthly payment over the duration of your loan, and fixed loan agreements usually last for 15 or 30-year periods. Despite this fact, some borrower-friendly lending institutions permit their clients greater flexibility with their payments by allowing them to select terms anywhere from 8 to 30 years. Advantages of fixed-rate mortgages. During the entirety of the loan life cycle, the monthly payment towards both principal and interest is consistent. Easier to budget housing expenses from month to month. Disadvantages of fixed-rate mortgages. A refinancing process might be required for individuals looking for a better interest rate after an unexpected cut. Adjustable rate mortgages typically have lower interest rates compared to traditional ones. Who are fixed-rate mortgages best for? Looking at staying in your house beyond 5 or 7 years. Want predictable monthly payments free from any changes? Then opt for a fixed-rate mortgage. Adjustable rate mortgage. Adjustable rate mortgages ARMs work differently compared to fixed-rate loans as their interest rates vary with the economic climate. But lots of ARM products will have your interest rates steady at first but then will adjust them for later terms. For example, you may come across a 7x6 ARM lending product, which means your interest rate will be stable during the first 7 years and then alter every 6 months later. An essential step in considering an ARM is to read through the small print so that you understand just how high your rates can climb and what fees are required beyond any initial offers. Advantages of adjustable rate mortgages. Fixed interest rates. When you initially own your home can be lower for some time, however there are no guarantees, and recently they have been similar to those for 5/6 ARMs. Reducing the amount you pay in interest can lead to significant savings. Disadvantages of ARMS. If the monthly payment to pay off a home becomes unaffordable, then they might be forced into loan default. If property prices fall in the upcoming years, prior to resetting your loan, this may make refinancing and selling more challenging. Who are adjustable rate mortgages best for? Planning to leave your house within the next few years? Consider taking up an ARM mortgage option. On the other hand, it is important to be content with some degree of uncertainty as to where your payments might go if you're continuing to stay in the property. Compare mortgage rates. Mortgage rates listed by individual lenders on their respective websites are considered to be sample rates. By factoring in variables like location and credit information from an ideal borrower, the lender can determine what interest rate to offer. To reduce interest rates on sample rates, some borrowers elect to pay optional fees known as discount points. Lenders tend to factor in discount points, which may result in the appearance of low interest rates. Providing information about you and the home you wish to purchase is necessary in order for the lender to determine your actual mortgage rates. For rate quotes that align with your personal circumstances, make sure to include key information like an estimate of your credit score along with how much cash you have available for a down payment and the duration over which you plan on financing. Comparing the sample and personalized interest rate options from various sources shall reveal noticeable variations. Therefore, to ensure you get the best offer on your mortgage loan, it's important to scout out various lenders. While fractions of percentages might appear small or negligible at first sight, they can make substantial contributions to reducing your total mortgage costs. Pre-approving your mortgage application with several lenders is a good idea, as lenders verify specific details of your finances during the pre-approval process. You will receive realistic interest rate offers and accurate borrowing amounts. From every lender you approach for a loan, you will receive a loan estimate, which makes comparing interest rates and lender fees easy with the use of these standardized forms. It's important to take into account all aspects of a loan when comparing rates, including the two most important numbers to focus on: the interest rate, annual percentage rate, which includes additional costs like lender fees that can greatly impact your payment plan. This leads many people to consider APR to be a more appropriate means for measuring the expense associated with borrowing. Factors that influence mortgage rates. Credit scores. Credit scores are used to evaluate the level of risk involved in a mortgage loan application. It is widely believed that a high credit score implies greater safety, but the bottom line is that the lender has confidence in you to make timely mortgage payments. Down payment. Making a massive down payment on your home helps reduce the loan amount and appears less risky in the eyes of lenders. Checking your loan-to-value ratio is advisable to verify this, especially if a high LTV typically means being at 80% or more. What is the classification of your loan? Your offered mortgage rate may vary based on the type of loan being applied for. It is typical for jumbo loans to carry a higher interest rate. Your application for the living space usually results in a lower mortgage rate when buying your own home instead of an investment property or vacation rental. The United States economic conditions will definitely affect mortgage rates. However, non-market elements, including elections, may also influence mortgage rates. Interest rate changes are often a result of shifts in inflation and employment levels. The global economic situation will affect the U.S., and global political concerns may cause mortgage rates to decline. But news with positive implications can lead to higher rates. The United States monetary system operates with oversight from the Federal Reserve, which aims to keep a balance between controlling inflation rates and encouraging employment opportunities. Lenders may adjust their mortgage rates following decisions made by the Federal Open Market Committee on whether to raise or reduce short-term interest rates. How to reduce your mortgage interest rate. Shop round. When looking for a mortgage, be sure to speak with a variety of lenders, as different lending institutions, such as mortgage bankers, national and regional banks, and different kinds of credit unions, may offer distinctive loan options with particular interest rates and fees. Depending on the needs of the borrower, Lenders provide specialized services like lending for the acquisition of new homes or refinancing current mortgages. Selecting the best loan requires carefully weighing your options and accounting for your particular situation. Improve your credit score. Even when taking out multiple loans, your credit score plays a significant role in your ability to acquire reduced mortgage rates. Similar to how bigger initial contributions lessen long-term costs related to mortgages, boosting your credit score also entitles you to lower interest rates and fewer monthly payments. Low credit scores are typical of high-risk applicants for lenders. The annual percentage rate APR that the lender will charge you for the loan may be higher if you have a low credit score. When applying for a loan with a high credit score, the likelihood of receiving an offer with a low interest rate rises. Choose your loan terms carefully. Since there is less risk involved, mortgage lenders can charge lower interest rates for short-term loans. In exchange for quicker principal repayment, these loans do, however, have higher monthly installments. The installment amount can be made more manageable by extending the payback period by choosing a longer-term loan plan with a higher interest rate. Having greater monthly disposable income or saving money must be chosen. While longer-term loans provide more consistent monthly cash flow, short-term loans assist you in conserving. Make a larger down payment. The amount of the loan's outstanding debt decreases as your down payment for a mortgage rises. If your down payment is higher, you may have more early equity in your house. A smaller amount of the original borrowed capital must be repaid in order to reduce the computed net interest paid over the duration while also reducing total payback costs. Buy mortgage points. If long-term financial savings are your goal and you intend to reside in your current residence for a considerable amount of time, then purchasing mortgage points may be advantageous. Each point on a mortgage costs 1% of the total loan amount and is paid at closing. You receive a lower interest rate in exchange for covering these costs upfront, which lowers your monthly mortgage payments. Lock rate. Consider locking in your interest rate to lessen the impact of fluctuating mortgage rates before to closing on a home loan. Prior to the completion of your home loan, you can guard against future rises by locking in a low interest rate. If you anticipate a change in interest rates, it can make sense to pay a fee to lock in your rate. You are protected from rising mortgage rates by locking in your interest rate, but doing so also eliminates the opportunity to benefit from lower rates. Find out more about how to protect yourself from rising interest rates by asking your lender about rate locking with a float-down provision. Refinancing your mortgage. Renegotiating the conditions of your mortgage can result in cost savings over the life of your loan. There are a variety of refinancing alternatives available, but each one has pros and cons that must be considered. You might find ways to lower your mortgage payment by examining the various refinancing choices that are available to you.